All right, let's talk tech now with Glen Kacher. He is the founder and chief investment officer of Light Street Capital. Get his insights on part of the conversation that we just had. Welcome back. It's nice to see you.
Great to see you as well.
Is now the time to take some chips off the table in the MAG, what some are calling Lag 7 now?
Well, I think Adam's got a great point there that definitely we're seeing increased CapEx spend. And the move that we made as far back as a couple of years ago was to shift a lot of our funds into what I call the AI 5. So those are the companies, the big semiconductor companies that are really taking advantage of this CapEx spend from the MAG 7. So that includes NVIDIA, TSMC, AMD, Marvell, and Broadcom. And those are lagging as well this year. They're about in line with the MAG 7, but last year they outperformed by quite a bit.
I wonder then, I mean, if you're leaning into what has been part of the eye of the storm from DeepSeek, right? We had the huge sell-off in a lot of the chips, NVIDIA included. I mean, how much clarity do you have in your own mind as to how that trade is going to do and the threat that this all could be?
Well, look, you go back to the basics. There's nothing in the technology pipeline right now that can match the innovation of generative AI. Generative AI creates a customized answer for the user based on real underlying data. And this is a brand new method of computing. It's created a massive investment cycle, over $200 billion a year of CapEx and growing in order to deliver on what is just an incredible technology, unlike anything else we've seen in my lifetime, certainly. And, this is, if you look back to the DeepSeek scare, look, a month or two earlier, we were worried that things weren't scaling. And then we saw a big scaling event, and now everyone's scared that we're scaling too much. We expect more software scaling. And after the DeepSeek fear, we saw Meta and Microsoft come out and say, look, this is how much we're going to spend. We're not slowing down.
I mean, the Meta run has been unbelievable. The Microsoft, not so much, enough that you got out of it completely, right? You swapped it for another name.
Yeah, we got out of Microsoft last year, still on the Meta. I think it's, as Bryn was saying, it's very clear how they are benefiting from their CapEx spend with the matching of content to users and then matching of ads to both content and users. So that's been very clear. And for us, we continue to, really want to have that exposure to semiconductors. If you look at what's happened to the multiples over, since the summer, the semiconductor SOX index is basically flat. And over that time, the S&P 500 is up 15%. Meanwhile, semiconductor fundamentals are continuing to improve. So the multiples now are much better for semis. The multiple for the SOX is down about 20% since July to 24.5, and the multiple on the S&P is up 9% since July to 22. So we've really closed the gap there. The relative multiples have compressed by 30% in 6 months. So in our view, semiconductor investors are irrationally bearish at this point. And we're seeing, for instance, short exposure of hedge funds very high, up to a 5-year high in the semiconductors.